Welcome back to Benjamins with Ben. Before we get started, smash that like button, hit that subscribe button, and turn on the notification bell so you never miss a post. For today's video, we're going to be looking at the definition of a recession, according to the UK, definition of GDP, definition of recession in the US, the key indicators that we want to look at when we're thinking about looking at what a recession might be or if one is coming, and how to prepare. Economists have been saying a recession is imminent, but the definition around a recession seems to be a little wishy-washy. At least at the time when I took economics, it was 2 quarters of negative GDP growth. That is contraction in GDP, which is gross domestic product. Just in case you don't know, the US has a more vague definition that requires a handful of economic metrics to be analyzed by a panel of economists who then deem if we were indeed in a recession. And then that judgment can't actually be made until after the recession has already happened. So if we're in a recession, there's really no way to know until we're out of the recession, which is kind of interesting. So a quick refresher on GDP. This is going to be the amount of goods and services that a country produces. When GDP is negative, it basically means that the country is producing less when comparing 2 periods. So usually that's the last 3 months versus 4 to 6 months ago. As an example, I'm going to throw up a chart on the screen. This is looking at cookies by quarter just to illustrate what negative GDP growth would look like. So we've got quarter over quarter here, and then between quarter 3 of 2022 and quarter 4 of 2022, we're doing fewer cookies by quarter. So this is basically going to mean that there's negative 10% quarter over quarter growth. This is kind of what we mean when we're talking about GDP contracting or having negative growth. Now that we know what GDP is and what a recession is, also know that the actual declaration of recession is basically decided by a bunch of economists, so that is people with degrees in economics, usually advanced graduate degrees like PhDs, and they get together in a meeting either in real life or in a Zoom room, and they're like, okay, how's job growth, how's unemployment, were we in a recession last quarter? And then that decision is made by them. At least that's how it works in the US. In the UK, it's a little bit different. So in the UK, they basically just use the definition that most people learned if they ever took any class in economics, which is just 2 quarters consecutively of negative GDP growth. How do we know we're going into a recession? There are a few things that we can pay attention to that'll give us a better idea. So these are indicators that this panel of economists would look at to figure out if we're in a recession or not. One of them being interest rates. So that's how much banks and the government charge for borrowing money. Lower interest rates equates to cheap money. So it's inexpensive to borrow money. The unemployment rate is just how many people don't have a job but are actively looking for a job. So if you're not actively looking, you're not included in that statistic. Same thing if you're retired. Job availability is how many jobs are available for every unemployed person. Quit rates are how many people are willingly leaving jobs, that is not layoffs or firings. And then layoffs, so how many people are being asked to leave companies because they can no longer afford to maintain the same size of workforce, or it could be that some workforces get bloated and there's too many middle managers and not enough people actually doing work, in which case there are also layoffs in non-recessionary times. How can we prepare? Time and time again, we've basically found that recessions are the best place and best time to be investing. This is when stocks and bonds both tend to fall. Right now, bonds are yielding higher yields. That is, you can get a good interest rate because interest rates are high. I'm going to throw up a chart on the screen. So this is basically looking at the daily S&P 500 index since 1928 in log scale. And this is alongside recessions and bottoms. So those are going to be the red crosses are the bottoms, and the recessions are highlighted in gray. This makes it a perfect time to be investing, even though indicators might be looking bad, or maybe we can't quite see yet what the indicators are doing outside of listening to company earnings calls and paying attention to how consumer spending is doing when we're listening to earning calls of banks like American Express, Citibank, JP Morgan Chase. That said, no one knows exactly where the bottom is. This means that 11 out of 10 times it's better to be dollar cost averaging into the market as opposed to trying to time the bottom. Typically, people can't time the bottom at all, ever. Dollar cost averaging is basically just putting a set amount into the market on a regular recurring basis. For best results, you should be doing that daily, though many platforms don't allow this. So you might be doing something like weekly or doing it bi-weekly after you get every paycheck. Really, just more frequent is better, and you can automate that on a lot of platforms. So if you do decide to dollar cost average like $1,000 a month into the S&P 500 index, over the next 20 or so years, you'll probably be making somewhere around $267,000 in interest alone, assuming a 7% return, which is in line with historical returns and then adjusting for inflation. We're going to throw a chart up on the screen again. You'd end up with a total of about $507,000 over just 20 years of investing $1,000 a month. If you've tried to time the dips and miss the 20 best days, just the 20 best days, that is in terms of returns off the bottom, over the course of 20 years, then you'd actually be coming out with negative returns. This is according to JP Morgan, using data from 1999 through 2018. Timing the market, you're probably going to lose money. So just put money in consistently and never stop doing it, and automate it if you can. So you'd be below the blue line in the graph that we'll throw back up on the screen, which is why the phrase time in the market beats timing the market. Talk to anyone in the finance industry, pretty much everyone is just dollar cost averaging into index funds or mutual funds, usually using products with low expense ratios like VTI, VOO. If they're doing anything with NASDAQ, then QQQM. The reason why they might be doing QQQM over just QQQ is that QQQM just has a lower expense ratio. It's just and most people don't know that because QQQ is advertised a lot more. Less than 1% of people can beat the market over the long term. This is data from the Performance Investing Group. This is basically showing the number of years that elapse versus your odds of beating the market based on what we've seen historically with investors in general. So this is retail investors, so this includes people in finance, and not basically after 30 years of trying to do that, you're not beating the market. We'll just call it zero. That's like many zeros, like a very small fraction of a percent of people who can actually beat the market over 30 years. We're going to throw another chart up on the screen. So this is a chart that's looking at the percentage of US equity funds that are outperformed by benchmarks. So if you look to the far right in the 15-year column, the second row down, you'll see that 90.46% of US equity funds get outperformed by benchmarks like the S&P 500. That is over 90% of financial professionals lose to the market over a 15-year period. The crazy part is that you can even automate your investing into these index funds. So you don't have to pay a financial advisor or wealth management person. If you're fancy, that's what they call themselves. Somewhere between 1% and 2% of your assets under management every year, which is very expensive. I'll explain in another video why you should never basically be paying any fees over 1%, and only in very certain situations may it even make sense to use a financial advisor at all. If you found this video at all helpful, consider subscribing to my YouTube channel. That is, smash that subscribe button down below, turn on the notification bell, and give us a like. If you have any comments, leave them on this post. I really like hearing what people have to say, if they have any suggestions for new videos, and if there's anything you want to be covered in a blog post. As always, thanks for watching, and I hope to see you next time.